Welcome to Live from the Vault, coming from Kinesis headquarters.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seeing inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
Welcome to Live from the Vault. This is the Liechtenstein Vault that we've been telling you about for quite some time. And we wanted to actually bring you and share some of this happy silver with you. Now look, this is not a green screen. This is real silver. Now look, this is what we're talking about here. We're talking about 1,000-ounce bars. And I'll tell you what, it's not just these 1,000-ounce bars and the 20-odd tons we've just brought in. In fact, if you pull up your Kinesis app right now, this is what it is. This is real. This is not in cyberspace. This is real physical bullion that is ultimately moving through the monetary system and is going to create you a yield and a return, which has never been done before. But you know what? It's not just about these 1,000-ounce bars. These are 4-9s bars. Now, pretty much everything out there you'll see is a 3-9 bar. Why have we gone to a 4-9 bar? Because it's quality. It's all about quality. Now look, you know, I mean, what can I say? Am I in heaven? Of course I am. I mean, and you guys know, you are in control of this silver. It is your silver.
Andy, nice to see you. How are you, my friend?
Welcome to the Kinesis Vault. Now, what am I doing? I'm sitting here in heaven, but you know what I'm sitting on here? 1,000-ounce silver bars. Everything Kinesis does is top notch. It is the epitome, the apex of what you can achieve. And I think one of the reasons I love silver so much and the reasons I love Kinesis so much, this phone here is sitting on a 1,000-ounce bar right now. That's your bars too. These are our bars. Yes, I'm invested in Kinesis, and you are, we all are, but these are our bars. And you know what? When you get on your app, that's exactly where you are. You can now see where your bars are. This is 20 tons that came in the last day or so. There's going to be many, many more tons arriving. This is going to be a very, very busy vault. So just wanted you guys to know, here we are. And I just wanted to also say one thing. Now, here, see this coin here? Okay, this is a 1-ounce 1902 silver coin. Now, why am I talking about it? Because it actually buys you 30 times more than a new $1 bill. Well, does that not say it all, guys? That's history talking to you.
All right, Live from the Vault. Welcome to the 50th episode of Live from the Vault, and we're actually going live to the vault, and you just saw that with Andrew Maguire.
50th. My goodness. Doesn't time fly here? But aren't we having fun?
That's amazing. Now you're bringing a whole new meeting to Live from the Vault. Andy, one thing I just want to ask you, I got a lot of questions running through my mind, but when you picked up that bar, tell us about how heavy was that? Because it looked like you just picked it up, but I know that those bars are massively heavy.
Hey, I may be 70, my friend, but I still work out. So I tell you what, it is. And you really, it gives you a shock when you pick up a bar like that, as you know. It's not one that you can pick up one in each hand. But I mean, hey, 1,000 ounces is 1,000 ounces, but of pure 4-9s quality. And I think that was the one thing that really gave me a lot of pleasure to talk about was the fact it was 4-9s bars, and not many people have always seen a 4-9 silver bar, and how shiny and how much different they are to even a 3-9s bar, which of course we love too. But interesting, eh?
Yeah. Now, so maybe tell us a little bit more about your trip to Liechtenstein, right in the Kinesis vault. I mean, that's amazing.
Yeah, and I think there was a clip there of our silver vault. corner of it, and also I think also the gold vault, a little snippet of our gold vault, which is actually a separate premises altogether, because silver, as you know, is it's in a bond. It has to be held in a bonded warehouse. But yeah, I mean, I think it is so rare. It's a really rare thing to be allowed in to film in a warehouse. Now, obviously, in a vault, you couldn't do that unless it was your own silver, because really you've got bar numbers there. And there are bar numbers. They're your bar numbers. They're people's. They're the Kinesis holders' bar numbers. So we've got nothing to hide here. But obviously, normally you wouldn't be allowed in a Brinks or a Loomis or any other vault, because you'd be exposing other people's bar numbers, which technically could be, especially on the blockchain, could be drilled down into an actual ownership.
Well, very, very, very exciting, and I'm sure looking forward to heading out to Liechtenstein and visiting too. Now, Andrew, let's get the show started. Welcome everyone to Live from the Vault. We're very, very excited to have you here. And Andrew, I know between these episodes and after that you identified the gold settlement price into the BIS OPEX on the 30th of September, maybe we can start this episode by looking into the action and what it indicates and what should we expect this time around.
Yeah, a great question, Shane. Honestly, this is really, I mean, obviously, if you're a stacker, hey, this is not an issue. You probably just really, well, so what if there's a better price? So what if there's a bigger price? Ultimately that what you're doing is you're buying for the future, and preserving your wealth. But we do get a lot of questions, because a lot of traders and a lot of people are also looking and say, hey, where can I capitalize best on this, what is basically a tale of two separate markets. And so whether you're a stacker or a trader, it's really good to look at, where the lines kind of cross best between these two separate markets. And now the two gold markets being the divergence between the highly leveraged paper gold market and basically how much this paper market price has diverged from the unleveraged real physical supply demand fundamentals. And if you want to know what physical supply is, just look at that video. That is a snippet of real physical. And it's the physical side of the market that tells us where the market making insiders privileged to have gold accounts with the Bank of England are also positioning. So essentially, let's start by drilling down really, which is the kind of question really, into the very short-term action, because that always gives us a better view as to what, obviously from a longer-term perspective, hey, this is just noise. But last week's CPI beat, and that revealed really that the Fed's transitory narrative began to be questioned in the mainstream. We hadn't seen that really before. And the market must now weigh in that the Fed, hey, has possibly made a gross policy error, which is not really rocket science when you think about what we already know, and one of the many reasons why we are buying gold and silver, as are other central banks. So as far as gold's concerned, though, now, given that the market has now baked in a probable 90% chance of an interest rate hike for September 2022, and possibly commencement of hikes as early as July, I mean, this is being bandied about, we should now look at how these two distinctly but kind of viscously linked paper and physical gold markets are positioning. So following this CPI shock, and I think that's where we start, crosses last week, and the crosses meaning the crosses between the foreign exchange markets and the bond markets, et cetera, but how they more affect the gold and silver markets, they began evidencing a substantial pickup in safe haven wealth preservation flows into physical gold. Naturally, that CPI shock, what that did was shake a lot of people's, honestly, shake your head, because if you have not read what this possibly means, then you need to start thinking about hedging your other risk positions at the very, very least. but it's about wealth preservation. And so really gold, the physical gold versus the paper markets. The paper markets are kind of algorithm correlated. We talked about this before, about the algorithms. And basically, they're correlated basically to the dollar and bond market. So, and given that yields began to back off from their respective recent highs, we actually saw also some inflows into the paper gold market. So that always worries me a little bit on a short-term basis, because these guys are not they're not in the taking delivery business. They're literally speculative. So, always watch for those kind of moves. If there's a spike and it's not 100% physically driven, and bearing in mind there's a massive amount of leverage in the paper market, hey, you've got to position yourself for a little bit of a pullback. And that's exactly where the focus now shifts onto the divergence between the accelerated selling of global fiat currencies, dollar, yen, etc., to exchange it for physical gold, versus the short-term kind of chart-painted technical action, which really has to live in the paper gold markets, because really the physical market is not interested in those technicals. Now, the currency exchanges for physical bullion, they're not just evident in dollars, but as we outlined in our last episode, also rubles, yuan, euro, and now for a third consecutive month, very large Indian INR exchanges. So in other words, Indian buying, physical bullion buying has been huge. And when you combine these, this is very large unleveraged physical buying. Now, these central bank sized physical gold accumulations, they're noticed by everyone in the real markets, except the blinkered COMEX speculative traders, which the house rely on to game the ever-tightening paper to physical envelope. So they know, that insiders know, that the physical envelope is tightening. We've got Basel III coming up, etc., etc. But really, if you can game enough synthetic non-delivery interest in, i.e. you get enough people to come into the casino, then you can rinse them. And that's really what we're seeing, but it's a tightening envelope. And we've evidenced the highly leveraged paper markets becoming really increasingly disconnected from real supply demand fundamentals. So that's driven recently by rising bond yields. And this algorithm-driven synthetic divergence really has reached about the limit of this envelope. And while we anticipated some insider official profit taking after the short squeeze, you remember we saw the CPI beat and then the short squeeze, and you saw gold and silver spike higher. Well, we knew that we figured that probably there was going to be some retracement. And because a lot of it was speculative driven, and it set up gold, but it set up gold for a strong, physically driven catch-up rally, even though we've had a bit of a pullback. Now, both downside moves in gold and silver futures were 100% COMEX driven by speculators into very strong physical market, which is why insiders exposed to the physical market are 1-to-1 long against all these sellers, i.e. they are taking everything that these speculative sellers are selling.
Well, Andrew, I got to tell you, about, I would say 12 to 15 years ago, what really got me interested in the markets, especially silver, was hearing you talk about the markets in terms of the paper casino markets and the physical markets. And maybe you can elaborate a little bit on this, because that was really what started me on the journey. Once I understood the difference between this paper casino market and the physical, I've never bought a single ounce of paper casino, gold or silver. But maybe you can elaborate for our subscribers, especially for the new people.
Yeah, and Shane, and that's power to you, because that then you are not part of the problem. And I think everyone that invests in paper, it's fine if you have a strong balance sheet and you have a plan and you can't be rinsed. In other words, you haven't borrowed money from the casino. Then obviously you've become part of the problem. So, but yeah, Shane, this is a perfect example. I think the perfect example is actually, because it's always good to look at a recent example. Look at the action since our last episode. Now, while both gold markets, I'm not talking about gold and silver, I'm talking about both gold markets. Now, gold, silver has the two markets too, but while both gold markets have rallied higher, and I'm talking about the paper and the physical market, from the Bank of International Settlements options mark-to-market event on the 30th of September, which we talked about last time, but they've risen for basically similar reasons, which is wealth preservation, safe haven demand. The difference between these two gold markets is that in one market, which is the physical bullion purchases, they're unleveraged, fully paid for long-term investment positions utilized by stackers, investors, sovereigns, central banks, where none, not a single ounce of these physical purchases are ever offered up for resale. So the speculators trade in the paper markets. They don't want the cost of inventorying real physical and then going through the trouble of reselling it. So on the other side, on the other hand, from the physical market, it's a non-delivery paper market consisting really of nothing but highly leveraged. It's a highly leveraged paper market, and the buy and sell orders really, even though they're paper, they're so leveraged they influence the spot market price, and this is what causes this unnecessary volatility that we see in the gold market, silver market too, and exactly what we've witnessed over the same period since our last episode. And these paper trades are really largely technically driven speculative trades and dutifully reacting to the ebbs and flows of the officially managed dollar index bond yield crosses, which sets them up for the house to rinse. This is a tool that the house uses. It's this group of speculative traders that provide the fuel for insiders to game this tightening paper to physical envelope. And what they've done is successfully conducted another psychological operations that keeps the paper traders programmed to expect that every physically driven rally will be retraced. What they're missing is that there are stair steps under this where it cannot be, where we're setting up higher and higher support points. And so it's these led by the nose spec rinses they're only possible to the degree that there is that the amount of paper market selling dilation can be sucked in, while the officials and the insiders continue to use that to cover off their naked long over-the-counter gold positions as the Basel III deadline approaches. Now, a quick note on that, because I've seen lots of misinformation about this. While we see Basel III extensions reported in the general market, this is not the case as far as the net stable funding ratios for gold are concerned, which is, of course, the key issue.
Hey, Andrew, so what sort of price action can we expect as this battle unwinds here?
Yeah, Shane, that's good. Good question. And again, we looked at the short term. In the medium term, really, in our last episode, we'd noted just how wrong-footed already these led-by-the-nose group of margined spec traders had become into this psychological operation of the Bank of International Settlements rinse at the end of September. And that we said they were ripe for an upside rinse, which indutifully they were. Now, as we previously assessed from the wholesale market footprints, it's really quite evident that these market-making insiders have consistently been going one-to-one long against these speculators, both in the physical and the paper markets. Now, this is an important point, as these insiders are actually positioning long. And aside from what we can determine in the wholesale markets, there are really some clues that come to light in the smaller silver market, where we evidence the predatory swap dealers, which is, let's call it the house, positioning long against the speculators at their expense. So this is a classic house setup, utilizing market maker position concentration, i.e. the house, the dealers at the desk, basically, employing house-driven, high-frequency trading algorithms, and they can influence the direction of the momentum-driven automated speculator algo trading decisions. Now, these speculator algos are really just trading a tick either side. They have no direction. They're trading a tick either side. Now, but if they are led by the nose, by the high frequency house algorithms, what they do is obviously follow that trend. And that's exactly what's happened. And right now, the driver, from time to time, that driver changes. It's right now related to the dollar index, bond yield crosses against paper, gold and silver. So, but regardless, 95% of all the chips they loan to the speculators are recovered back to the house at a discount and a profit. The exact formula that is employed by every single casino out there. But very short term, while the COMEX-driven technical trade was exploited by insiders, they were bid pulling at the round number at 1800. We saw that, and they're not going short. They're using position concentration to just simply, and they're supposed to be making a market. They're not supposed to be colluding, but by bid pulling, jointly bid pulling at a round number, what are you going to do? You forced a rejection and of the 1800 round number for very short term, while the conflicting, very strong physical market tells us that this action is actually really counterintuitive and it's very short term in nature. And that the $30 drop we saw into the Friday from the CPI, which was ignited in extremely thin liquidity at the market open, was purely technical and was jumped all over. I know that everyone I know in the wholesale market was all over this. Now, really, it's about self-fulfilling technicals. They rely on house-generated, non-deliverable open interest. In other words, creating flows of paper gold that don't exist. And while these technicals influence the placement of physical buy orders, because naturally, if you see this coming down, you think, well, okay, I'll buy it, thank you, I'll take it at a better price. Obviously, they do not trigger physical sell orders. That's the key issue. It doesn't matter what you see in the form of a discount. It's not triggering sell orders. It's triggering buy orders. And there are no physical bullion sell orders, period. Whereas if we look at the exchange-traded funds, GLD, SLV, etc., their on and off ramps rely on unallocated gold and in no way represent real supply demand fundamentals. And they're just one more tool to game the paper markets into making bad choices. And what we're discussing here is while the paper markets churn this unallocated gold, what it does is confuse the real supply demand fundamentals, which are in fact extremely strong. So really, just like after non-farm payrolls, if you look at the chart, you'll see after every spike higher for real reasons and the retracement, and the next CPI spike higher and the retracement, it always takes 1 or 2 sessions for the speculators to wake up to the fact, realize they're wrong-footed, and really, they're wrong-footed again. And looking at the current divergence, really, we see 1800 should be overcome pretty quickly, and then it'll become support. Now, the divergence between the silver physical market and the current paper market price is even more pronounced, which indicated that really deeply oversold silver should ultimately outperform gold from here on.
That's amazing, and just seems like it's a little bit of a dangerous game for someone gets caught offside on this whole thing. But Andrew, just before we started recording this episode, you mentioned some interesting action in silver. Can you elaborate and maybe talk to our community about this?
Yeah, Shane, and what made me think of it or bring it back to mind was having revisited our silver vault there, where we were looking at all that real physical silver in real physical form. This is actually, this is something very, very bullish. And I'm not sure it's realized yet because it only happened yesterday, which is Tuesday. It reared its head out of the blue. And what this information tells us is that silver is going to have to rally from current levels, and any dips from here on has to be jumped on aggressively by insiders. So if you're looking for a technical dip, a big technical dip, which I've seen profit all over the place, forget it. What happened was the information involves Turkey buying up all the remaining wholesale silver bars that were left this year and front running everyone by paying a massive premium to secure these bars. And so while it's not yet realized by the paper-driven speculators, deeply oversold silver is reacting to this very strong physical demand. So in other words, the paper guys have not worked this out yet. And yet what we're seeing is massive, strong physical demand. And while we've evidenced the physical tightness over the last couple of weeks, none of this anticipated that a very large fresh Turkish demand would front run what was remaining. And that is really unusual. We've never seen Turkey come into the market like this in this kind of size. So yesterday, Tuesday, this sucked out all the remaining available wholesale silver supply at a massive premium. And that's how they did it. They were prepared to pay well over the wholesale odds to literally scoop what was earmarked for other people. And what it's done is forced refiners now, and we spoke to Heraeus this morning, to push out wholesale orders to next year now. And we're talking about wholesale orders, we're talking about 1,000-ounce bars. So wholesale silver is now really commanding very large premiums, which is not yet reflected in this paper-driven price, but it will be. And I can guarantee insiders are all over silver right now. So regardless of the speculators selling paper silver on their algorithms into rising bond yields or strong dollar, silver will now have to rally in these extremely tight physical conditions. So what I'm saying is pullbacks in silver will be shallow and extremely buyable. I think this is a massive opportunity for silver stackers and literally tabled yesterday.
Awesome, awesome. Talking gold and silver with Andrew Maguire. Hey, buy physical. You know, it's great to understand this a little bit more and even better help others understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They are not the same. So there you have it. That's all we have for you today. Another fascinating episode of Live from the Vault. Please help us spread the word about this channel by liking, sharing, subscribing. Click on that bell if you'd like to be notified as these episodes go live. So in the comments also, go ahead and ask your questions regarding the gold and silver markets, and your questions, you never know, may pop up on a future episode. So with that, we'll see you next time on Live from the Vault. Bye for now.